Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy, in financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you all know, we invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HIROC, is tied up in some meetings and earnings results today. He may be able to get on the call, but we're not 100% sure, but we'll hope that he may. But our financial planner and wealth forecast specialist, Bianca Tomlinson, is with us as well. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website on the home page. And while you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, as we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing is even more important this year because of the even greater levels of uncertainty imposed on us by a host of developing factors. Inflationary expectations had been rising at the beginning of the year, but recent data suggests inflation is stalling and even falling more recently. Now, while other central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% on March 15th and is expected to do so in June and perhaps at least one more time after that in 2017. Stock market valuations are at 14-plus year highs, putting stock prices well above the price of the 10-year average valuation. At the same time, in the U.S., economic growth has not kept pace with stock market advances. And the Trump agenda continues to run into political hurdles. Brexit has been initiated and French elections have rejected populism. Meanwhile, protectionism concerns continue to rise, especially in Canada, and then throw in the escalating tensions with North Korea, and we have quite a blend of uncertainty to monitor. And one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds in the U.S. and also in Canada. And I notice Paul's on the call, and I just want to see if he's got anything to throw into the mix here with regards to these correlations at this point. Nope, maybe he's not quite on the call. Okay, moving on. So when we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. And we are patient, waiting for opportunities to buy assets when prices come down. Well, the benchmark equity index that we use for comparison has returned close to 15.5% from this time last year, but only about 4% annualized since this date 2 years ago. So this gives you a pretty decent idea of the volatility that has occurred over this 2-year time frame. And meanwhile, the benchmark bond index has had only a marginally positive return over the last couple of years, leaving investors with a greater weighting of the bond ETF with little to show for it. Now, while we make comparisons to the bond benchmark, we do not use bond ETFs in our client portfolios unless they are much smaller account size. And each week we look at how short-term and longer-term returns have progressed in our benchmark ETFs for comparison to client portfolio performance, so we can continue to monitor our clients' progress. Now, each client will likely have different starting points and may have different allocation weightings. So for newer clients, there may be some differences in their personal portfolio returns, especially in the short term. So we want to focus on more longer term returns because that, in the end, is how we will be judged, achieving our clients' long-term goals. And as we look at longer-term HIROC client performance, the one-year performance after fees is now well ahead of the benchmark by almost 2 percentage points. There are underweight equities, and that's the reasons for that in more detail a little bit later. Portfolios have a lot less volatility than the benchmark in the short term because we are very conscious of risk. And as a result, our tactical approach is able to provide better risk-adjusted returns. In other words, you do not have to be as focused on the higher risk equity markets to get safe growth. As for the long-term performance over about 4.5 years, well, it speaks for itself, well ahead of the long-term benchmark by about 3 percentage points. And we continue to focus on the difference between absolute returns and risk-adjusted returns. What is most important is that the actual HIROC private client return per unit of risk taken, which on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. Graphically, you can see that the absolute return for the HIROC private client is higher and the risk taken is significantly lower. And as we do constantly remind everyone listening that historical returns are no guarantee of future returns. But at HIROC, as you also likely know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date and, of course, heading in the right direction. Well, we are watching the inflation story closely. As all central banks have a mandate to maintain price stability, we are focusing on inflation as a key to determine if and when interest rate policy may change. Now, while total inflation data has been rising on a global scale, most recent data has shown it to be slowing. Now, the Bank of Japan, Bank of England, and European Central Bank have kept rates steady and monetary policy unchanged, as has the Bank of Canada. The European Central Bank held its benchmark refinancing rate at 0% for the 10th consecutive meeting and left the pace of its bond purchases unchanged on April the 27th, as was widely expected. What they had to say was that a very substantial degree of monetary accommodation is still needed for underlying inflation pressures to build up and support headline inflation in the medium term. If the outlook becomes less favorable or financial conditions become inconsistent with further progress towards a sustained adjustment in the path of inflation, we stand ready to increase our asset purchases in terms of size and or duration. Headline inflation has been recovering from the very low levels seen in 2016, largely owing to higher energy price increases. After reaching 2% in February 2017, Euro area annual inflation stood at 1.5% in March. This reflected mainly lower energy and unprocessed food in price inflation, but also a decline in the services price inflation. Looking ahead on the basis of current futures prices for oil, headline inflation is likely to increase in April and therefore to hover around current levels until the end of this year. However, as unutilized resources are still weighing on domestic wage and price formation, measures of underlying inflation remain low and are expected to rise only gradually over the medium term, supported by our monetary policy measures, the expected continuing economic recovery, and the corresponding gradual absorption of slack. So basically, in a nutshell, the European Central Bank is still concerned about inflation and growth and will remain concerned until they see further evidence to the contrary. And the Bank of Japan left their key interest rate unchanged at minus 0.1% at its April 26, 2017 meeting, as widely expected as well. Policymakers also decided to maintain its 10-year government bond yield target around 0%, but said they raised their economic growth forecast to 1.6% for fiscal 2017 from an earlier projection of 1.5% due to rising exports. And all of the Bank of Canada's core inflation indicators are currently below their 2% targets, which means the Bank of Canada will remain on hold. And as you can see, all four different central bank interest rate expectations there on the screen. You can see the U.S. is significantly higher than Canada, certainly than the Euro area and Japan. Well, Canadian economic uncertainty on trade with the U.S. and NAFTA renegotiation, also the low interest rate environment, the housing market bubble and potential fallout, including the home capital worries, are all putting pressure on the Canadian dollar. And you can put lower oil prices into that mix as well. Oil prices at their lowest levels this year. Well, in the U.S., first quarter GDP came in at a pretty soft 0.7%. Annualized rate of growth. Economists, however, expect a significantly better second quarter at this particular point in time. But all eyes will be watching consumer spending, which was the main cause for the slower first quarter growth. The largest automakers in the U.S. sparked concerns that years of high-flying demand are over. Today, the industry had their fourth consecutive monthly drop, with Ford and Honda reporting the steepest decreases in April. The six biggest automakers missed analyst estimates. Another month of weak sales raises the prospect that car makers will need to boost discounts and cut production to address swelling supply on dealer lots, particularly as credit tightens. Manufacturers Ford and General Motors joined auto parts and dealer stocks, leading some of the S&P 500 index biggest declines in trading today. Well, consumer confidence in April turned lower, and the U.S. Federal Reserve's key inflation gauge, core personal consumption expenditure price index, fell in March and remains well below their 2% target. Meanwhile, key employment and unemployment data in the U.S. is due on Friday. U.S. jobless claims have risen in recent weeks, and the unemployment rate is now expected to climb back to 4.7% from 4.5% in March. Note here the interesting inverse relationship between the S&P 500 and jobless claims over the longer term. Of course, this could be impactful if jobless claims continue to rise. So we're going to be watching those fairly closely in the coming weeks and months. We also will be monitoring the unemployment rate closely to see how it changes relative to that 3-year moving average that we discuss from time to time. Historically, when those lines intersect, the recession has followed shortly thereafter. Now, with expectations of a 4.7 unemployment rate, the gap will narrow to about 0.5% from the current gap of about 0.8%. So if we start to see that gap narrowing, of course, that will raise some caution flags for us. There is no expectation of any change in monetary policy from the U.S. Fed following their meeting tomorrow. However, as I mentioned earlier, it is widely expected that they will raise rates again in June. Again, they are data dependent, and that means they'll be watching all the economic data that comes out between now and then in order to help them make any decisions. Well, there's been little change in the U.S. yield curve over the last week, but bond markets are still acting in a cautious manner, as bond markets do tend to lead all other financial markets. That just makes us cautious as well. On the debt watch, it is not in the headlines, but we have been pointing out from week to week the risks of record amounts of global debt. If interest rates do rise, this puts increased pressure on servicing that debt. Canadian household debt is at record levels. U.S. household debt has jumped back to higher levels than it was in 2008, and emerging market companies and countries have been building debt as well. As for our look at value, with lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.6 times, close to its highest level in 14 years. Oops, wrong chart, so we'll try again here. While the 10-year average is at 14 times, this means that earnings will have to grow by about 20% more than they are currently expected to bring the ratio back to its 10-year average. or that either that or the S&P 500 will need to correct by about 20% or a combination of the two. Now, while quarter one earnings are surprising slightly to the upside, it is a result of expectations being over the course of the first quarter. Now, it's not anywhere close to justifying where current prices are at this juncture. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. And even if second quarter GDP comes in at a significantly higher level, stock prices are still in need of some correcting to get them back to what we would consider to be more reasonable levels. And as I've mentioned the last couple of weeks, it really has only been 10 stocks that's been responsible for 50% of the growth in the S&P 500 this year. And most of that has been technology, internet stocks. 3, Apple, Facebook, and Amazon by themselves have been responsible for a third of the increase. Now, the lack of depth to this market does concern us. High equity prices equate to high risk in owning that particular asset class, and as we have proven, you do not necessarily have to own a full weight of that asset class to achieve long-term growth, long-term reasonable risk-adjusted portfolio growth. So for the moment, we are continuing to avoid being fully invested in equity assets. Well, as we do each week, let's turn to the geopolitical front to see what's been going on. The U.S. government found a way to avoid a shutdown by agreeing to kick the budget down the road until September. Healthcare is still on the front burner, but progress is stalling. And tax reform and infrastructure spending, especially the big tax cut to 15%, will not likely see the light of day until late this year or early 2018. In the meantime, President Trump threatened Tuesday to force a government shutdown later this year after congressional Democrats and Republicans struck the budget deal that largely neglected his priorities. The European Union governments threw down the gauntlet to the UK ahead of the Brexit talks, listing demands to Prime Minister Theresa May that she must satisfy before they will discuss the trade deal she wants, and urging her to be more realistic in her expectations. Any doubts about the scale of the task facing Britain in withdrawing from the EU after 4 decades were laid to rest at a Brussels summit of the region's leaders last Saturday. A tough negotiating stance was endorsed unanimously within minutes and to applause. The UK responded by saying it's bracing for a confrontation. And investors and traders did not wait to celebrate the victory of centrist candidate Emmanuel Macron in the first round of France's presidential election on April 23rd. Relief at what was seen as a market-friendly outcome to the first round of the French election faces a test from the runoff vote on Sunday, this coming Sunday, May the 7th, when the heavily favored Mr. Macron faces the far-right National Front's Marine Le Pen in the final vote. Well, North Korea today accused the U.S. of pushing the Korean peninsula to the brink of nuclear war after 2 strategic U.S. bombers flew training drills with the South Korean and Japanese air forces in another show of strength. As Reuters reports, the 2 supersonic B-1B Lancer bombers were deployed amid rising tensions over North Korea's pursuit of its nuclear and missile programs. North Korea said the bombers conducted a nuclear bomb dropping drill against major objects in its territory at a time when Trump and other U.S. warmongers are crying out for making a preemptive nuclear strike on the North. The reckless military provocation is pushing the situation on the Korean peninsula closer to the brink of nuclear war. That's what the North's official KCNA news agency said today. Any military provocation against the DPRK will precisely mean a total war, which will lead to the final doom of the U.S. Ironically, the flight of the 2 bombers on Monday took place roughly at the same time as Donald Trump said he would be honored to meet North Korean leader Kim Jong-un in the right circumstances. Well, so here at High Rock, with all of the upheaval happening around us, we continue to monitor event risk, which we think is high, and, of course, price valuation, which we also think is too high, and we will add or reduce holdings tactically in our models as opportunity presents itself. We will also maintain our disciplined approach to our strategies with skill, competence, and continued deep levels of research, adding value and reducing risk so as to give us all the best possible risk-adjusted returns. Paul, are you on the call?
I am on the call. Can you hear me?
Yep, I can.
Good.
Any updates that you have for us?
Well, you just mentioned we've been adding and reducing certain things, but one of the things we've been reducing over the past number of weeks has been some of our exposure in oil equities or stocks. So we have reduced some of those. I'm less bullish on oil, and I've been that way for the last few weeks, and getting more bullish on natural gas and getting more bullish actually on cobalt. So we did add a specific high yield bond in our tactical model that I know pretty well, and it has cobalt exposure. Cobalt has skyrocketed, and I think the street is missing some of the impact on the cobalt production in this mining company. Away from that, I've been spending certainly the past number of days here on the Home Capital and Equitable Bank situation. We don't own any of the stock or bonds or GICs, deposits, or anything else in either of those companies, but it certainly may affect or will affect capital markets in Canada, and it's an extremely complex situation. So I am spending some time here with some guys on it and trying to get up to speed as quickly as possible.
You mentioned that, and I think it's important that all our clients know that in light of this situation and in concern of the potential, and it's not necessarily going to happen, but the potential for some contagion effects, we moved our clients' cash equivalent holdings to out of the money market fund at Manulife. Not that Manulife is in trouble, but certainly just to avoid any sort of residual impact into a little bit of a safer haven with TD, correct?
That is correct. I mean, the Lifecos are really not big players in the residential mortgage market at all. In fact, the banks are a lot bigger, but the deposit base of the bank is enormous and a powerful machine. So, I'm certainly not worried about the insurance companies, but we are taking a more conservative approach here with our overnight cash investments, and that's why it's so important to be doing this research, Home and Equitable, because we may even find ourselves, who knows, I think it's a very remote possibility, but we may find ourselves wanting to move into T-bills themselves. So I'm doing the work on it, and I'm on top of it, that's for sure. I wrote a blog on it yesterday.
We wouldn't, yeah, I was going to mention that. Yeah, and it's not the first time that we would have moved into T-bills just for safety purposes.
Yep.
Okay, well, that's great. Thanks for the update. I know you've had a really busy day, so appreciate that you've joined us on the call. Okay, well, folks, that's it for us for today. If anybody who's on the call would like to ask a question, please feel free to do so. Okay, no questions today, but we do invite you all to, and if you're listening to this recorded version, have any questions, any feedback, we please feel free to send us an email, because we certainly want to be able to answer all questions. But that's the end of today's show, so we will be back with our next update next Tuesday. Until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great week, and for all you mothers out there, a happy Mother's Day.